Hey guys, Devin Norcross here, Norcross Consulting Services. Today I have a very special guest. His name is Aaron Arlington. He's with Flat Branch Home Loans out of Joplin, Missouri. Aaron and I are new contacts. I was scrolling Facebook as one does, and he had recently made a post similarly to a post I had recently made. We're both a little upset with how Dave Ramsey advises some of his clientele. I certainly see a lot of clients that are big fans of the Dave Ramsey program. I operate a lot in Tennessee and Kentucky, and I know he's obviously a national financial advisor. But my advice was simply to, you know, take his advice with a grain of salt. Aaron had a really well thought out response to it. And so I reached out to Aaron to see if he wouldn't mind sharing that with my social media, and since then we've become new contacts. So, Aaron, I appreciate you joining me today, and yeah, I think I'd like to just pass it along and let you educate the listeners.
Yeah, well, I appreciate the opportunity, Devin. So I'm obviously not a huge fan of Dave Ramsey. I think he misleads a lot of the general public. I think he's an expert in how to pay off debt. But as I like to say, he needs to stay in his lane when talking about other things like not needing credit or needing a credit score. I think Dave lives in a fantasy land, and for some people it works, but I would say for the majority of people, it doesn't when it comes to other things like credit. And so the post that I ran across was, give me a reason or give me reasons why somebody needs a credit card. And he had zero reasons because he's totally against credit cards, because he's totally against having credit scores. So I did him a favor and I listed just a few of my top reasons why somebody should get a credit card. The biggest thing is building credit. And what I tell people, I'm a mortgage banker. I help people finance home loans for a living. And when somebody needs to either build or boost their credit, what I tell them is you need to open a credit card. And I explain to them, I go on and I say, you're not opening a credit card to go into debt. You're opening a credit card for one reason, and that's to either get your credit score up so that I can qualify you for a home loan, or maybe get you a better interest rate or whatever. But you're very intentional. You open the credit card, you put a tank of gas on the credit card, and then once that balance reports, you pay it off in full. The credit card company can't charge you a dime of interest. So you've then utilized that credit card and basically taken advantage of that credit card, because you've gotten something from them, right? They've boosted your credit score. They've gotten nothing from you. Now they're making money off of the merchant, right? But that doesn't come out of your pocket. And so that's the number one biggest reason. Number two, I personally use credit cards. I may be a little bit more savvy just because I'm in the industry, but I charge all of my expenses on my Capital One credit card so that I can earn cash back points. And doing that, knowing that I've got the money sitting in the bank to pay that balance. Honestly, what I do is I don't pay once a month when the due date is, when it comes due. I pay like every other day. I log into my account. I've got a mobile app. Most credit card companies have mobile apps now. It's super simple. You just log in, and whatever your balance is, pay it off. And that way you're not worrying about, oh man, when is my payment due, or do I have any, money left on my credit limit? So that's how I do it personally. Credit cards are great for traveling. If you need to rent a car and you put that charge on your credit card, most credit card companies offer car rental insurance. I took my family to Disney World several years back, didn't put it on a credit card, and I actually got into an accident, and I had to pay out of pocket what my normal auto insurance wouldn't pay. But had I put that on a credit card, I would have been covered. I found that out later. So lesson learned. Number four, we kind of talked about, credit cards are great for establishing, building, strengthening, or boosting your credit or your credit score. And I've helped so many people who have applied for a home loan that I couldn't get approved at the time. But, I used my credit simulator tool, and I was like, hey, if you'll just simply open a credit card and after the first month that it reports, your credit score will go from this to this, and we're good to go. And it's a great feeling when people actually listen to your advice, they do it, and then you can get them into a home.
Yeah.
Let's see. Another reason was um, so credit cards. What I tell people is credit cards are the number one best credit score booster. So you do want to have a mix, like mortgage, auto. There's all types of loans out there, but no loan that I'm aware of, in my personal opinion, no other type of account that reports to the credit bureaus boosts a credit score like a credit card.
Yeah,
And
there's twice as many points in the FICO scoring models to revolving credit as there are installment. They know you're much more likely to pay something back if they can come take it from you. If they can come get your car, if they can kick you out of your house. Your loan worthiness is a much better indicator of something that they can't come take. That unsecured debt is really the best indicator of loan worthiness.
Yeah, that's awesome. I didn't know. So it's like double
Yeah.
any other account.
Yeah.
As far as points go.
Yeah. And as far as the ratios, we recommend here at Norcross Consulting, we recommend no more than about a 1-to-3 ratio, revolving versus installment, or subsequently installment versus revolving. We do have clients occasionally that come into the program. They're more of a 1-to-10. They have an auto loan and 10 credit cards. And so we're going to identify accounts that we can pay off and close at that point. And as a rule of thumb, we're only looking at the newest accounts. Very important to the borrowers to understand you don't want to close those old accounts. So let me piggyback on something you said earlier. The most important thing that people understand about credit cards, number one, there's a ton of points associated with credit cards in the scoring model, but it's really about the fact they're open in perpetuity. I mean, FICO does not award any points at all for closed or inactive accounts. So you take your student loan out of deferment, or put your student loan in deferment, you don't get any points for it. You consolidate, 5 student loans you've had for 10 years into one new payment. You lost 5 accounts with 10 years payment history. You pay off your car, you pay off your mortgage, you lose this payment history. The only way to keep long-term payment history is to have credit cards. Otherwise, you start over. If you pay off everything you have today, 6 months from now, you will not have a credit score if you do not have credit cards. So, I'm going to say something that is hearsay. I do not know this to be true, but for years, I've been told that Dave Ramsey is a partial owner in Churchill Mortgage. Again, allegedly. Okay. With that being said, Churchill Mortgage prides himself as being a portfolio lender. So there's a reason he pumps that mortgage company over any others. They do. Portfolio lending is a completely different type product than most people. If we're not building credit, we're at a missing opportunity to leverage. I've got so many clients who put 3% down on their house, and 2 years later they sold their house out here in Denver for $150,000 profit. So it's just outrageous to advise people of that capacity. You mentioned credit card rewards. So I want to give people a quick little trick that I've done. I've had a companion pass with Southwest for about 11 years now. Anyone flies for free with me. Okay. One of the tricks that I always like to tell people is the beginning of the year, if you don't have a Southwest credit card, okay, Southwest uses Chase. They have 2 regular credit cards and a business card. At the beginning of the year, if you don't have one, if you watch, they will run a 50,000 mile bonus for a credit card. Okay, so you can get that credit card and get 50,000 miles. If you've traveled or used the card, if you get to 110, you get your companion pass. But if you do not have any Southwest credit card, you can get both of them, the Premier and I don't remember the other one, Premier, and you have to look it up. They're sitting around here somewhere. That would give you 100,000 miles. Okay. At 110,000 miles, so either a couple flights or spending a little bit of capital, you get your companion pass for this year and the following year. So you could get a companion pass for 2 years by doing that. I think you have to spend a total of $3,000 per card before you get that reward. But if anyone out there travels a lot and is looking to take someone with them, and that 110,000 miles, you don't lose that. You still get to use those miles towards flights. My wife and I here in Denver, we got back. We went to Mexico and back for 15,000 miles. So it's 15,000 for me. She flew for free, not quite for free. I think you pay $8. You got to pay some taxes, but that companion pass is huge. I know my buddy does. He owns his own business and he runs tons of merchandise. Home Depot, Lowe's, and just tremendous savings on that. Another thing I was going to point out. let me do this since I have this up. I'm going to do a interested in a longer educational PowerPoint. This is something I do with real estates and lenders and veterans groups, everyone else. So your credit card balance impacts your credit score on the exponential scale. That's this upward balance banana curve. So as a general rule of thumb, as mortgage professionals, as credit card professionals, we always advise people to keep their credit card balance below 30% of the limit. And the reason is, if you look at this top corner, is actually your penalty. So at 30% of your limit, you lose about 10% of the points available to that specific card. It's not cumulative. They don't look at your balance of credit limit on all cards and add it up. It's on a per card basis. At 50% of your limit, you lose about 30% of the points available to the card. And then about 75% of your limit, you lose about 90% of the points. So it's important to understand one of two things. Yes, it's great to keep your balance under 30% when you can. Zero is not the best. I personally lose about 90 points if I don't have a balance on any of my credit cards. Aaron, I'm sure you've seen that and had to have clients go put money on their credit cards.
Yep.
But it's important to know when to pay. All right. Your due date is when you accrue interest. Okay. I am a huge fan of auto pay. If you can get yourself on auto pay, it will save you worlds and worlds of headache down the road. But make sure when you go on auto pay, you select, entire balance. If you do pay minimum, it's easy to lose track of that. But every card you have has the reporting date. In fact, every account you have that reports to the credit bureaus has a reporting date. It's one day of the month that they upload your balance to the credit bureaus. I've seen a lot of times with smaller, I don't want to say smaller, but banks that target threshold credit score clients like Capital One, First Premier, Credit One. A lot of times they report that balance around 7 days before the due date. Okay. So if I take a scatter plot of 1,000 people and I say, when do you pay your card? Most of them are going to pay at or before their due date. But the credit card vendors are reporting that balance just before that. They're doing that intentionally. It's called rate spiking. They want to report your balance at its highest point. It's going to lower your credit score. Their cards are all variable APRs. You're going to get a neat little letter in the mail saying your interest rate's now 17.9 up from 14.9, because even though you paid your card down before your due date, they reported you prior to that. So my advice is to call the number on the back of the card and make sure you're talking to a call center within the US. If you're not, ask to be transferred. But you can always find out what your reporting date is. So if I'm going into a purchase process of something of size, I'm going to make sure I'm targeting my cards before the reporting date. If I'm not purchasing something, I'm okay with my due date. It's going to save me the interest. So so I just want to touch on that. Let me stop this screen share here.
That's a huge piece of information that I would say most people don't know. They don't realize. They just think, hey, I paid my full balance before it was due. I'm good. I did everything I was supposed to do. They don't realize that most companies report the balance before the due date.
Yeah, I work a lot with a lot of rural areas, Central Illinois. I've been through parts of Missouri, Tennessee, Kentucky, Virginia. A lot of my clients, when they come to me, do not have much credit history or are very distrustful of credit cards. So it's not uncommon for me to find someone with maybe one credit card. Maybe it's a small credit card, like a $200 Walmart card. So we talked about 30% earlier as the advisable range to keep your credit card at, but separate to that, of your entire credit score, 30% of your entire credit score is based off your balance to credit limit ratio. And that 30% is split up between each card you have. But if you have one card, if you have a $200 Walmart card and your balance is $160, it's inconsequential. It's only $160, but that's 80% utilization. And that's 80% of the loss of your 30% of your total credit score. So, really important to keep your eye on this stuff. You want to have a card, you want to know when it reports. Certainly, if you don't want to use a card, that's fine. But before you go sit down with Aaron and talk about what, fantastic refinance rates, I'm not to say before, because he can do a rescore and fix that. But anytime you're going to be looking at purchasing a vehicle, purchasing a home, even if you like to live debt free, it's highly, highly advisable that you get a credit card. If you're absolutely against credit cards, get an overdraft line of credit on your checking account. Okay, that's a revolving account. Just do something, and it's not going to be perfect because it's not going to have a balance on it, but it's just it scratches scratch it checks that mark. And we really want to see our borrowers, get the best interest rates possible. And anyone out there, I can tell you from a personal 15 years of looking at credit reports, I've never seen a 700 mid score on an individual. That is a mortgage FICO mid score. There's different FICO models. There's automotive. There's credit card. I've never seen an over 700 on a client that did not have a credit card. In fact, I've never seen over a 680 a client that didn't have a credit card. So, what do you think, Aaron?
Yeah, those are few and far between. Those are like unicorns. I have a question for you. What I tell people is, because I do get pushback, I'll be honest with you, credit cards have a bad rap, right? Maybe their parents have gotten in trouble, maybe they've gotten in trouble in the past. I've gotten in trouble in the past, but I've learned, right? So like when I tell somebody, hey, I can't get you approved, but if you'll open a credit card, and they're like, no, I'm not going to do that. I was taught either in school or by my parents or whoever not to get a credit card. I'm totally against it. What I've told people is, hey, if you don't want to use a credit card, don't use it. Open up the account and tell them, don't even send me the card because I'm not going to use it. Because even if you don't use the card, that credit card company is still going to report a zero balance every single month. And that's what you want. You want something positive to report to the credit bureaus every month. Would you agree with that?
Yeah.
I would say, if you don't have a balance, you do lose points. So I have told people, hey, you've got to go charge $10. I don't care what you spend it on. Go charge $10, and your score will go up even higher.
Yeah, I would say there's a good, better, best approach to that. So good is that you get a credit card, you don't use it. That's going to add points, not as many. Better is that you get a credit card and use it minimally. Best is that you do that and you seek out authorized users. Does your wife have a Kohl's card she's had for 10 years? I had a client with a $3.5 million mortgage and a 680 credit scores. After 2008, he was denied for his jumbo. He had probably 7 million in mortgages already on his report. The guy went ballistic. He was sent to me for a credit repair standing, but we just identified very quickly that he didn't have any credit cards. And the exact scenario was present there. His wife had a Kohl's card. It's been open for years. Kohl's is Capital One. Capital One reports authorized users. So we like authorized users a lot over here. They can be added and removed. You can get a credit card, and if you need to close it after your home loan, do it. Now, I will say, opening up multiple credit cards, there are things in credit that are an immediate gain, like opening up your first account, opening up your first credit card. Then there are things that are a short-term loss than a longer-term gain. So if I have 2 credit cards opened and I go open up a third, I am going to lose some points. By 3 to 6 months, I might lose 20, 30 points, depending on how much positive credit I have. And then, over time, it'll build those back. You don't really need more than 3. I have 3 mostly because of, different rewards that I or they're cards that are old and I don't close it. I don't fly United anymore. Try not to. But I see no reason to close my Chase United Mileage Plus card. I've had it for 7, 8, maybe 9, 10 years. So, there are new trade lines, car loans, credit cards. They are going to impact credit score negatively when you first get them, but it will be a long-term gain. So if you are considering refinancing or purchasing, Aaron, what states are you licensed in?
Missouri, Arkansas, Oklahoma, Kansas, and Texas.
You got it. So there's 5 great states there Aaron's licensed in. If you are interested in a refinance or a mortgage, I would encourage you to reach out to him. He's very, very knowledgeable about credit. Most, I won't say all, but most mortgage officers and banks and officers are going to be, I will say, most mortgage professionals will have some excellent advice for you. Be very careful what advice you get from your real estate agent. I can tell you right now, you need to be very careful what credit advice you take from a real estate agent. So I guess that's it. Aaron, is there anything you'd like to add to?
Well, just not to go off. I mean, it's kind of still on subject, but for people that watch this who are parents and they're wanting to kind of help set their kids up for success when it comes to credit, because they understand the importance of having good credit. Going back to what you said, looking for authorized users. What I do personally for my kids, I've got one that's 20, one that's 16, and one that's 24, 25. I can't remember. But what I've done for all 3 of them is I've signed them up as an authorized user so they can what I call piggyback off of my good credit. So starting from day one, when they're 18 years old, they have an excellent seasoned account that's number one, giving them a credit score. Number two, giving them a good credit score. So when by the time that, say they're 19, 20, and they want to get their own credit card or they want to buy their own car, they've got the credit score to do that.
Yeah, I'll say two things. That number one, that can always be done at a later date. So don't feel like you have to do it right when they're 18. It is an excellent way to build their credit. I can promise you that if my parents did that for me, I'd have bought a motorcycle as soon as I walked into a shop. So you might want to take a evaluation of your kid and see if they have the self-control for it. I would have got myself in a lot of trouble. I ended up buying a motorcycle with a student loan. That took forever to pay off. And number two, guys, if you're worried about your credit, I'm so sorry it took us all the way to the end of the video to bring this up. If you have bad credit, it's okay. There's secured credit cards. You put a small deposit down. Okay. I recommend a site typically called OpenSky. Their website's openskycc.com. CC, just think OpenSky credit card. They don't even do a credit check. And I've never had anyone denied. Okay. So if you are in that sub 600 range and you've been denied and you think you're not going to get approved, that's not the case. There are products out there for everyone. There's other things we can talk about on a later video, like getting your rent to report, getting your cell phones to report, things of that nature. I have mixed feelings on those, but please, if you are in the credit recovery stage, you need, number one, before you do anything, before you pay a single collection, before you consider paying a repo, before you do anything else, you need to get a secured credit card. And it seems weird that you actually want to open up a new account before taking care of old accounts, but it is absolutely the truth. That is what is in your best interest. So, well, Aaron, thank you very much, man. I am going to crisp this and throw a logo on there. And then just do me a favor. If you haven't, like my business page, and I can tag you when I make the post. And then once I do that, I will reshare. Personally, I will reshare that to my personal page. If you do the same, I think we might have a fighting chance of getting a couple eyes on this video today.
Okay. Sounds good.
All right, Aaron. Have a good day, sir.
All right, you too.